All right, let's talk about a classic problem for any investor. But this isn't really about just one single stock. Nope, it's about something bigger. It's about learning how to break down the financial advice you see everywhere and spotting the playbook they're all using. Okay, so just imagine this for a second. You actually get shares in a hot new IPO. The stock hits the market and bam, almost instantly it shoots up 67% from the price you paid. I mean, the excitement is through the roof, but then that big question hits you. And that's the age-old question, right? Do you take that amazing profit and run, or do you hold on, hoping there's even more upside? It's honestly the kind of good problem to have that every single one of us dreams about, but also kind of dreads. So this scenario, it brings us right to what we're calling the 67% dilemma. And the company right at the heart of this is a really big deal in the world of finance. Yep, we're talking about the National Securities Depository Limited, NSDL. So if you were lucky enough to get in on that IPO, you'd be looking at a 67% gain, just like that. And that puts you at a major crossroads. Do you hold or do you fold? Okay. In a situation like this, with all the excitement and noise, what you really want is an expert's opinion to help you see clearly. So let's dive into one specific analysis that did exactly that. We're going to look at some analysis that came from Gaurav Garg over at the Lemon Markets desk. He put out a really clear, super well-reasoned recommendation for anyone who was facing this very decision. So what was the verdict? Well, Garg made a really strong case for holding on to the stock, and his entire argument was built on three main pillars. Let's break them down. Okay, number one, NSDL has what's called a robust market position. What does that mean? It means it has a really strong, defensible spot in its industry. You can almost think of it like a castle with a huge moat around it. It's a major player, and that gives it a ton of stability when it comes to competitors. All right, point number two. The company has steady revenue visibility. Now, this is absolutely crucial. It basically means their income is predictable, it's consistent. And if you're a long-term investor, that kind of predictability is pure gold. It tells you the company isn't likely to have these crazy ups and downs in its main business. And number three, this is maybe the most surprising part. Reasonable valuations. I mean, you'd think after a 67% jump, the stock would have to be overpriced, right? But what this analysis said was nope. Even after that huge surge, the price was still considered sensible when you look at the company's actual financial health. So you've got these three things: strong market position, steady income, and a fair price. They all pointed to the same conclusion. The recommendation was a clear hold, especially for investors looking at the long term. The thinking was pretty simple. That initial pop was great, sure, but the real value was still down the road. Okay, so that's the what. We have the analysis, we have the reasoning, we have the final recommendation. But let's switch gears here. Let's pull back the curtain a little bit and look at the how. How does information like this actually get packaged and delivered to you online? Because underneath all of this advice, there's a much bigger picture. It doesn't matter if it's an online article, a social media post, whatever, there's an incredibly consistent formula being used. We're going to call it the information playbook. And this playbook, it usually breaks down into three really simple steps. First up, you've got the hook and the welcome. They got to grab your attention. Second, they give you the core analysis, the good stuff, the reason you showed up. And third, they finish it all off with a call to action. So, step one is the welcome. It sounds so basic, right? But it's actually designed to do two things: establish the creator's authority and make you feel like you're part of a community. You've heard it a million times. Welcome to my channel, followed by some fancy name. It's all about setting the stage. Then you have step two, which is the absolute heart of the content. This is the value. In our NSDL example, this was that core analysis we just walked through. The market position, the steady revenue, the reasonable valuation. This is the part that's supposed to give you the answer you were looking for. And finally, step three, the call to action. Come on, we all know this one. Don't forget to subscribe, like, and comment. But look, it's not just a friendly goodbye. It's a totally strategic move. It's designed to boost their engagement numbers, make the algorithm happy, and of course, build a loyal following for them. All right, so we've looked at this specific stock advice, and we've completely deconstructed the format it comes in. So what's the bottom line here? What's the real lesson for you? It really all boils down to that simple three-part structure. You've got the welcome, which establishes their authority. You've got the core analysis, which gives you the value you came for. And you've got the call to action, which drives their engagement. Trust me, once you see this pattern, you are going to notice it everywhere. Because at the end of the day, the point of all this wasn't just to figure out what to do with NSDL stock. No way. The real skill, the most important thing to learn, is to understand how that information is being presented to you. It's about making a shift from just being a passive consumer of advice to being an active analyst of the content you watch and read. So I'm going to leave you with this thought. The next time you come across a financial explainer online, are you just going to swallow the advice whole? Or are you going to take a step back, analyze the playbook they're using, and become a much smarter, more critical consumer of information? That choice, well, that's up to you.